Welcome to Strategies for Banking Stability Post-Crisis webinar, starring John Winnick, Clark Street Capital, the full-service bank advisor and asset disposition firm specializing in loan sales. Got that from your website, John. Hey, John, I don't know, when you say post-stability, all I know is I read the Wall Street Journal this morning and horror stories of more bank failures and office vacancies and office loan delinquents. So I don't know if this is post-crisis, maybe continuing. But you, John, you've put together an all-star panel. I'm going to let you introduce them in a second. Please ask questions. Use that chat function, and we will bring those in. We're going to have some polls. Please take part of that. This is also being streamed on YouTube. If you missed part of it, you can go back and review it. If you like what you hear, get the link, send it to people that you think may be of interest. John, you and I have been doing this for a while now. These are great webinars, great content. Tell us about your panel and tell me where I'm wrong if it's post-crisis.
Well, I think it depends on your definition of crisis.
All right, it is what it is.
But we'll get into all that. I'm pleased to join us. We've got Josh Siegel, CEO of Stone Castle. Jim McAlpin, partner at Bryan Cave. And Umrai Gill, Managing Director of Performance Trust. We're going to start with a presentation from Umrai. 6 months ago, Umrai was telling us about the 1,000 potential banks that were going to be unprofitable. Umrai, where do we stand? Take it away.
Thanks, John. Yeah, we for those who may not have gotten on last time, we put out a paper basically talking about this concept of the funding advantage. And we saw some really sort of some difficult data that the industry was going to have to contend with. So let's do a quick update on that. So I'm going to share my screen really quick. And this is as of Q4, so everybody understands Q1 data is actually being analyzed as we speak. But there's some really interesting conclusions when you kind of look back, John, and that is at the time we saw this cost of funds pressure building, and the asset side of bank balance sheets was really not keeping up. We had an industry that, from a profitability standpoint, looked like this. This is Q4 2022 profitability for banks over 125 million, and it's pretty clear to see the skew is to the right. So earnings really good. A year later, post SVB, post rate rises, and what we're describing as the great rates up. We now in Q4 of 23 have an industry profile profitability that looks like this. So you can see the bar charts have really pushed to the left. As it relates to the numbers, you can see that the number of institutions with a pre-tax, pre-provision ROA below zero over doubled over that year. Under 50 basis points, let's call it almost tripled. And you can see that there's still a number of institutions that have held on, but to the right, the number of institutions over that one pre-tax, pre-provision, and by the way, pre-provision is going to be a thing. Post-provision, excuse me, is going to be a thing that I know you'll talk about later on, John. But you see the population of these buckets changing. So it wasn't 1,000, thank God. That's a testament, I think, to management team adaptation, playing defense. But there's no doubt that these buckets, the lower profitability, are continuing to populate, that we expect to continue in Q1. Really quickly, why is that? Well, if you think about Fed funds rate at 5.5, in Q4, the average cost of funds was approximately 2.5. In Q1, that number is going to go toward a 3 handle. Our funding advantage in Q4 was 300 basis points. We think it's very logical to expect that funding advantage continue to shrink towards some equilibrium, which while we're much closer to that point, we don't actually believe we're there. Now it's partly rate dependent, so that assumes that rates stay where they are. So this is 2007, back when Fed funds was in the fives. Data tells a really interesting story. The funding advantage for the industry got to about 200 basis points, which showed up in a 3.25% cost of funds. So all that has to say is the pressure is continuing. It's not over. Hopefully the bulk of it's behind us. And at the end of the day, it's always the liability side compared to the asset side. And so I'll spare the viewers all these numbers, but just know the asset side continues to struggle to keep up, and therefore margins go down. So kick it back to you, John.
No, you're on mute, John. You're on mute.
John, you're on mute.
It's all right. Josh, any thoughts on what you heard from Umrai?
Well, of course I have thoughts. I think it's pretty consistent with what we've seen in the banks that we touch, which is about 1 in 4 banks. Loan demand is down, harder to make profitable loans at the credit quality they want. So we've definitely seen a reduction in the interest in more deposits, right? So that's obviously a canary in the coal mine. That's a stark difference from a year ago. I think Umrai also touched on, and so did you, which you'll get to, right, is the post-provision question, right, and how that's going to play out. But when you think about the banking industry over a long cycle, which is how I always try to approach it, NIMs will normalize, but its rapid movements of interest rates are always a challenge. And I think we're only in maybe the third inning of the game as it relates to adjusting loan yields, which would be based on a loan duration, whether it's 4.5 years or 4 or 5. We're only 1.5 years in. So we have still a ways to go and more pain to suffer just to get through this cycle. So like anything, the folks on the top of the curve, they'll be fine. They make a little less amount of a lot of money, but the guys on the bottom, that's going to be more of a challenge. And the question is, can they survive? Can they make it through before their loans reprice?
So what do you think happens to these unprofitable banks? A lot of cases, they have high quality assets. I've looked at one the other day. They had almost 0 NPAs. Their asset quality was pristine. Unfortunately, their average yield was, I think, in the 3s. So hard to make money when the yields are that bad.
I think if you took, and again, this is academic because it's not real world. If you took a bank that has good asset quality, like really good asset quality, but has a cost structure problem, one of two things will happen. If they have excess capital, they'll just burn down capital as they try to survive this until things normalize. If they don't have enough excess capital, then they'll sell. And they'll be a buyer, because if it's a good franchise that just is in a bad interest rate position, they'll merge away and take out cost and survive. If they have asset quality issues and they have this issue, then they're going to be a candidate for failure.
Yeah.
John, we often in conversations like this, we tend to focus on the worst case or the tough part. I want to compliment the number of banks last year that around May, June figured out the world had changed. Interest rates were rising, were going to continue to rise, and redid their budget for the year. And I think that actually has a positive impact on the numbers that Umrai showed, and in part because people like Umrai and his company were sounding the alarm. And it would be interesting if we could do a show of hands for the bankers. Unfortunately, we can't on this call. How many of you finished the year with your original budget? I'd be surprised if it was more than 10%. And I think the industry kind of got the message about mid-year, and that really had a big impact, Umrai, I think, on those numbers. People tightened their budget, read forecast, and it was a tough year last year, but I think it was good what was done mid-year.
Yeah, Jim, I couldn't agree more. I wish, as is always the case for those that serve the industry and want to make impact, that everybody got the notice. But what we're going through is it's a period of survival adaptation. And I think this is where you see the management and governance philosophy, company to company, and how it's either turning into action to play defense, to adapt, or perhaps in some cases lack of action, or perhaps in some cases there aren't that many alternatives for action because it's just too difficult. So it's sort of the movie's playing out in front of our eyes. And what I'm encouraged by, Jim, is if you fast forward it, you will see an industry that, albeit fewer participants, better, stronger, faster.
Yeah. And Josh, you know, through your investments, what I saw late last year, I was fortunate to do some strategic planning all around the country. So I got a glimpse. Certain parts of the country, banks were able to quickly raise their interest rates on new loans, You know, markets like Philadelphia, Atlanta, in Florida, other parts of the country, not so quickly, you know, the Midwest, upper Midwest. And I do think that also has kind of an impact. It's kind of a geographically segmented challenge we face as well.
I think it's geographic and probably also deposit market share. If you have a highly competitive market, I think it's easier to pass through the marginal cost. If you're one of two banks in a market, then it's harder.
Yeah. I mean, a head scratcher to me is, okay, if we're in a banking crisis, and obviously that's debatable, if we're in some level of crisis here, aside from NYCB, nobody's really been fired. You really haven't seen the types of changes in management teams that you saw back in the financial crisis. I'm going to have some thoughts why, but what do you guys think about that?
Well, I think you have to have a crisis before people get fired, and I would say we're not in a crisis. Just looking at the data, I think we're under strain. I think it could develop, but we're not there yet. If people don't adjust, and from what Jim and Umar said, more banks are adjusting, right? Their budgets, their expectations. If they don't adjust, then we could start seeing a greater number of institutions under stress or fail, but I don't think we're there yet. So hence you're not seeing that kind of reaction.
I have a thought on that. To go through and I'll this is maybe a prep talk for Jim, who actually sits on boards, but to swap out management as a board forces you to think about the independence of the organization for at least another 3 to 5 years, or forces you to do it if you feel like the organization needs a better home, if you will. And so I think, John, part of it may be for those of us that operate in thinking about M&A, right? That is a way for shareholders to vote in terms of are they behind management or not? And that's been really gummed up because of these interest rate marks and other things. So, Jim, I don't know what you think, but let's assume the mark issue ends up resolving itself one way, shape, or form, either time or lower rates. What do you think in terms of M&A being the way that, I'll say, put it in air quotes, management teams get the vote of no confidence?
Well, I'd be interested in Josh's view on this too, but there isn't a whole lot of M&A going on right now, and likely won't be for the rest of this year. According to numbers I've seen, and y'all may know this more accurately, I think last year was the worst year for bank M&A in over 30 years. And this year is shaping up perhaps to be worse than last year. So there just aren't deals to flee to at present. So my sense is that, most boards and management teams now are kind of hunkering down, and they took the first steps mid-year last year. Their budgets this year are more conservative. I mean, there's built-in hope, but no real expectation of significant changes in rates. And I think particularly now that we are, but it was interesting, to John's question. I think, John, last year was a real aberration. And I think, all management could basically say, who could have seen that many rate hikes coming in 1 year, right? I mean, no one could have foreseen that, right? I guess Josh did, but I certainly didn't see it. And I think where you're going to start seeing some stress on management is this year and next year, where if there is no M&A market to flee to,
Yeah.
and you're really going to have to be creative in your approach to kind of continue to make money, continue to make the goals that you and your board have agreed to.
Yeah. Well, I mean, there's some life on the M&A front. I mean, Heartland Financial or HTFL Bank sold to UMB Financial yesterday. You know, that'll create a $65 billion regional, super regional bank. Obviously, it got Capital One and Discover. But I guess from your point, Jim, it sounds like the number of activity, that the actual number of activity is fairly low, and there isn't a lot of rumbling going around that this bank is talking to this bank and so on. Is that kind of your position?
There's a fair amount of talk. There's always talk, and the investment bankers are very active right now. But you know, if you actually kind of, all right, well, let's put this together. What would the pricing be like? It's depressed. It's really depressed pricing. So, you know, 1.3 of book or something. I mean, who wants to jump with joy over that? So I think if you have some kind of combination, you know, stock for stock, where you see the combined entity really having some opportunity a couple of years down the road, then it makes sense. But if you're looking for a cash deal right now, it's a terrible time. Terrible time.
Yeah, but it does go into that cliche, beggars can't be choosers.
That's true. If you are a beggar, yes.
Yeah. Well, that brings us to our poll question. This is for bankers only. This poll question is your bank's attitude towards M&A. Are you highly likely to acquire, be acquired, moderately likely to acquire, be acquired, or little or no interest? I think we're learning so far that the attendee list here is a poor prospect list for an investment banker. I mean, Jim's this kind of, you know, you've got a good gut feel on your community bank clients. I mean, is this kind of consistent with what you're hearing from the banks you work with?
Yeah, I think you'd have to add some time frames to those questions, John. I just don't. In the next, you know, if you were looking forward 12 months from now, I don't see that much of a change for someone to say, hey, we're highly likely to be acquired. Unless, to Josh's point, you really need to do a deal.
Yeah.
I do think this next wave, you'll have the losers, but I think you'll also have some of the next fast growers, right? It's that when the house is on fire, valuables are often left behind. And when people start pulling back, the enterprising and well-run banks will run in and say, well, people are generally moving away from all loans. I'm just nervous. Right. I don't know. And they have the pick of the litter to put on the best and sort of reestablish themselves as, you know, the new franchise. I mean, that's sort of what in the financial crisis Connect One did. You know, they were a little Jersey lender and seized the opportunity to lean in. And there were a lot of those stories. So we may also see some folks who grow organically just by stepping in.
Right.
Yeah, one of the things you got to be careful with, though, you're seeing also a few examples of this, is not only is the rate move really hurting balance sheets for standalone entities, it's gumming up M&A, as we know. But if you announce a deal and you see rates move 50 basis points, and you spend all this time and money and energy and regulatory application, and you've talked to your shareholders, you've set expectations. And then you come back, you know, 9 months later, right? These things are not taking less time, they're taking more time. And all of a sudden you get a tap on the shoulder that says, well, if you want to get over the line, you're gonna need to raise some capital.
Yeah.
Which is what's happening. Lakeland Providence is an example. So all I has to say is there's a lot of demotivation forces out there to even step out on the ledge. Now, over time, is it needed? Yeah. I mean, the net overhead ratio for the industry has been in secular decline and is only going lower.
Yeah. Just looking at the stock price for UMB, up 3% today. So, I mean, the market seemed to like their acquisition. So, I mean, there does seem to be enthusiasm amongst the bank investors there. Switching over to credit, just have a couple slides for you. Now let's start with the first one, go back one. Just want to give you two examples of the loss severity that many banks may face, will face if office loans go bad. Obviously, this is a minority of office loans, and not all deals look like this, but it's our view that the loss severity for a large downtown office building loan that goes bad is likely to be north of 50%. And here's a couple of good examples. 216 West Jackson, not too far, as you can see from the map, from the Sears Tower or Willis Tower. This was a loan made a little over 10 years ago for $16.5 million. The balance was $14.4 million before things went bad. By any measure, this is not an attractive office building. It's Class C. It's a mid-block site. It's no one's idea of a great property. But for 185,000 square feet, the sale price of, was that $13 a foot? Pretty bad. And the lender on that loan was a CMBS lender, recovered 18 cents on the dollar on that project. I also have an example on the next slide. This is a property in suburban Columbus. If you could go over one slide. This was a very nice suburban office building, Class A, construction 2006. Columbus is a market that's doing quite well. But what's tough here is this was essentially a single tenant building. So BMW Financial occupied this entire building. And, they left in late 2022. And it was sold for $1. It was a complicated deal, but I've learned from sources that it was purchased for about $7.2 million by the Noor Islamic Cultural Center. Obviously, when a office building is being bought by a religious institution, it's probably not a top dollar. And you can see here the loss was 75 cents. So, pretty big severity, on what we're seeing in office loans. These are definitely some harsher examples, but they're not uncommon.
So are we at the beginning of providing for these types of potential losses? And how much are out there?
It's hard to say. I think what's difficult in our world, we're actually likely taking an office loan to the market tomorrow. And this is a situation where it is another single tenant building, essentially, with a lease that comes due at the end of next year. So, some deals are very binary, right? If you have a large tenant and they're staying, exhale, the building's likely to make it to the other side. But once one of these buildings kind of goes sideways, it gets ugly in a hurry. I do think there are reasons to be optimistic from the standpoint that the return to office isn't great, but it's not getting worse. We're averaging, low mid 50s now in physical occupancy. That's not getting worse, but it's not getting much better either. So I think the banks, though, that have reserved 10 to 12% for their office portfolios, I don't know if that's the right number, but it's not peanuts. I mean, those are pretty significant reserves. And obviously those reserves cover the whole portfolio. And, I just think that the loss given default on these is going to be not what people typically model for a real estate loan.
Yeah, it reminds me.
Go ahead.
I was going to quickly say, Josh, it reminds me, I'm having a little bit of a flashback to a year ago where when I saw those photos, especially the mid-block downtown Chicago building, which is where I lived for 21 years. And it's amazing how the world changes unpredictably. I flashed back to a year ago when it was liquidity, it was interest rates, it took the system like 6 or 10 months to really get their arms around what that means. Like, it's not easy for a management team to recast their future when the world is changing really quickly. And now the question is, are we doing an appropriate enough job as a system of adding to rates and liquidity and the margin stuff, this credit overlay, and what that looks like in terms of shareholder returns and strategies that management teams should be taking.
But Josh, what do you, I mean, as a bank investor, what direction are you giving bank management teams with respect to credit? Are you encouraging them to be proactive, pretend and extend? What sort of advice are you telling them?
So the advice that we tend to give them is to do a realistic internal assessment loan by loan. So depending on the market you're in and depending on the specifics of that property, if there's a realistic chance that over time the value will come back, right? Doesn't mean rates will drop. Rates can stay flat, but as the world adjusts to this more normalized interest rate, things get back to normal, transactions occur. So if there's a realistic expectation that the value can start to return, then you might as well restructure and keep it going. Looking historically in all of the MSAs, there's never been a period in the last 60 years where the nominal value of real estate, not inflation adjusted, but nominal value 10 years forward is less than it was 10 years earlier. You can pick month to month going forward. So inside that period, you could take a loss, but if you can find a way to survive, it likely works out. However, if there are underlying fundamental issues, right? Net population leaving a market, right? Or something that is going the wrong way, then I think you come back to, and the advice to the banks is your first loss is your best loss and just get out, right? Take the hit, move on. Because the benefit, or let's say the upside right now, is whether it's fixed income or real estate, people were sort of holding their breath, waiting for the Fed to drop. And so they just didn't want to transact, right? The bid ask was too wide. I think we're now starting to come out of that as people capitulate that, okay, I guess this is where we are. So now we just have to make some decisions. And I think that those decisions will definitely start to drain capital from taking realized losses, although we are in the best capitalized banking system we've probably seen in our careers. So they can afford to take some hits. And CECL did some good work of building up reserves. But those hits have to come. And I think we're getting to the point here in this year and probably into early next year where they're going to have to start realizing those losses. And look, ultimately, even that building you said, which was sold for $2.6 million, I mean, come on, there's somebody there that says, let's turn that into residential condos. I mean, the price point gets low enough.
Sure.
There's a use for something. And maybe the bank takes the hit, but it's not going to be razed to rubble. So we've been sort of waiting for the cycle. I think we're now going to have to suffer that cycle.
Yeah. Well, the issue to some extent is the carry cost, right? I mean, you could buy a 10-unit retail strip center with 4 occupied units. And if you buy it at a low enough price, you can cash flow. The issue with office is between the property taxes, the maintenance, and the need for leasing commissions, and to show the market that, hey, you've got some money to convince tenants to come in your building. It's banks who do want to wait this out and do take these assets into REO, or they set up structures where they're managing the asset. It's going to be a long hold, and they're going to have to throw some good money after bad money potentially.
They may. I mean,
their fingers.
I wouldn't be surprised if I start to see more enterprising institutional funds, the big hedge funds and real estate funds who approach maybe some of the larger banks saying, look, I'll cut you a deal, restructure the loan, I'll come in, I'll put the new capital, I'll cover the carry cost, and you can participate in some portion of the increase in the future. We saw a little of that in 08 to 12. We haven't seen that yet because it hasn't developed enough, but I think we may see those kind of situations that will help banks smooth that hit and sort of put their money along with the people who can afford to ride that out until those 6 units are filled.
Hey, Josh, if I'm maybe 95% of people on this call, what I'm thinking is, well, our office portfolio is de minimis, or we don't have a lot of exposure and we've already looked at it. What does it mean for the preponderance of CRE, right? Where banks, community banks under a certain size, it is their largest concentration. It's different asset classes, different varieties of it. Those, what's the immunity level there?
And I have a view. It depends what disease you have, right? If you have a lot of owner occupied property, right, not non-owner occupied, then you're gonna just you're not as sick as someone else might be, right? If you're in a stable rural market, you might not be facing the type of vacancy rates, right? It's very market specific. And I think the danger as a bank investor is just drawing a brush and saying, well, the industry is blank. The industry isn't anything. It's a collection of 4,000 portfolios.
Yeah.
I think you have to look at each one, because in certain markets, it's going to be destructive. In some markets, it may be a nothing burger.
Yeah, and for a lot of the smaller banks, a lot of their loans are a pretty short duration. They're construction oriented, and they're to borrowers who are not building huge facilities. They're building 2 or 3 townhomes. They're building a strip mall. They're building, so that I think, to your question, can be more carefully contained and with more stringent underwriting. I also think, frankly, we all tend to look at everything in relation to the Great Recession because we all lived through it. But the banking industry is different. Now, banks are different. I think they're as was pointed earlier. I mean, they're better capitalized. And frankly, I think they're better managed on the whole. Because we're down to a lower number of banks now, and I think on the whole the management is better and is more focused on it. And most of these people live through that. They don't want to live through it again. So I'm hopeful, particularly for the smaller banks, for the folks that are involved in the larger, in any way, participations or otherwise, in these larger commercial projects. I don't know. Josh, your points are really well taken.
John, Jim, you bring up another important point. In 2008, what really precipitated the collapse was that most of the assets were held in structured vehicles. And a structured vehicle is unforgiving, right? It's a set portfolio of assets that has to run off. And as it degrades, they trigger EODs and you liquidate, right? It's a self-fulfilling disaster. Banks are living, breathing entities. We sort of say it with a negative tinge, extend and pretend or kick the can. But the reality is that buys time, that smooths the hit. And having an active lender, not a structured lender, does allow you to work through these issues. And that will soften the blow compared to 2008, even if this does get worse.
Yeah, I mean, on Josh's point, there is zero chance that a office borrower with a CMBS loan can convince the servicer that they want to convert it to residential use. Zero chance. They'll just say, F you, pay me off. I mean, that's basically what the way it works. Jim, your point, I know you serve on the board of bank director. They did an interesting survey last month where they simply asked banks what their 3 most significant strategic challenges over the next 18 months. Deposit pricing was number 1 by far, 64%. Interestingly enough, attracting and or retaining talent, 40%. Yeah. Evolving regulatory compliance requirements, 39%, and liquidity management, 32%. Only 9%, mentioned credit. Now, this survey does skew towards smaller banks.
Right.
Jim, this kind of, reflects, what you're hearing is to a lot of these smaller banks, credit is not their number 1 worry. That's not keeping them up at night.
Yeah, but deposit pricing is a challenge and continues to be, and it doesn't look like it's going to get any better this year, unfortunately. But it's an interesting time, fascinating time, Jim, and it's very unpredictable.
Yeah, Jim, the deposit. If you think about deposits as the raw material, as our friend Johnny Allison likes to say down in Arkansas, is if that's hard to come by, which means they're dear and they're expensive, then the marginal rollover, the refinance, the number of banks you got to call to get one term sheet, that's happening, I think. And that's another maybe wild card factor, liquidity, really, cost and availability, that I think keeps the credit conversation with us for a while.
Yeah.
Yeah, and also,
Well,
it
on the
kinda
off-
go ahead, John.
No, in the office space, CMBS is the only lender on office right now. So even if you're not well versed as to what financing is out there for office, I would encourage any bank with office loans to get their arms around what terms and conditions are in the CMBS world, because quite frankly, they're the only lender right now in office.
Good point.
Josh, you've been bearish on the regional banks for a while. I know I asked you this before, but your mindset is they're kind of stuck in the middle. What do you mean by that? And how can regionals figure it out and be more competitive?
If I had that answer, I'd buy one and take it over. The challenge that they've faced systematically is they're too small to compete with the JP Morgans, the Citis, the B of A's, right? They're just not to that scale. They don't have, wealth management, capital markets. They just don't have the full service to compete multinationally. The other side is they've generally gotten too big to have real local community connection. Small banks always generate a higher yield on earning assets than large banks because the customers, is just data, is the facts. The customers don't mind paying a little more for that relationship. That's just how it is. And the lack of scale is what sort of erodes that extra NIM. So the regionals have a challenge in talent. They have a challenge in competition, and culture becomes more difficult as well. So they, other than like some rare exceptions, they tend to have a hard time changing the corporate culture to adapt to the world, where a smaller organization can. The thing they really only can compete on is price, and that's hard right now, right? Because loan pricing is sluggishly catching up to where rates are. And so that makes it even more difficult. And so how do you differentiate? I don't know. I do think that barring regulatory pushback, there would be a lot more M&A in the regional space.
I agree with that, Josh. And I think one of the great challenges they have is technology. If you look at the largest banks and their annual spend on technology improvement, it's just mind-boggling. It's it's the GDP of small countries that these large banks are spending. And if you're a regional bank, let's say you're a $50 billion, $60 billion regional bank, you don't have those kind of internal resources. And so your technology often is not much better than a large community bank. And people notice that. People notice that because these are, when you get to be that big, you really are retail oriented. The smaller banks are not retail oriented. They're mostly commercial oriented. When you get to be that big, you are retail oriented. And people notice the difference between what they can do in their B of A account and what they can do on their regional bank account. And it's stark sometimes. So I think that's a great challenge, particularly going forward with the younger population.
And but it's not, Jim, it's not just from what I've seen. The spend is a part of it, right? But without giving up some names of regional banks where I know a lot of the senior folks, there may be the will in the executive suite. There may be some will on the board, depending on how comparatively youthful the board is. The greatest challenge I've heard from the regionals is that the management team a level down, the head of the retail bank, is just resistant to putting in a new core. I have to retrain my people. It's going to cause risk issues. We don't want to. It's actually human pressure that is internally been pushing back us. Like, I know one that has an institutional bank and a retail bank, and they're run by different parts of the organization. The institutional side is very forward thinking, very tech friendly, very much leaning in. And they just lament the person running the retail side who is resistant to anything changing. So you have a lot of cultural, that's what I was touching on, cultural. They have cultural problems. You talk about Jamie Dimon, things go one way downhill from him, right? If he wants something to get done, it's going to get done in that organization, not just because of him, but the culture that he's built over a very long period. But these regionals, they're just more often than not, maybe PNC is an exception, they're just in an old mindset generally, and there's a lot of institutional resistance to change.
Yeah, we saw that a couple of years ago. Same phenomenon for this segment of bank that you're describing. So not small enough to be nimble, to get paid for the risk you take, to have pricing power, and not big enough to compete efficiently. And you end up in this mode where you start doing, as Warren Buffett says, hard to outcompete your dumbest competitor in a commodity market.
Yep.
So there's really, like, you're in no man's land in terms of advantage. And lower deposit ratios in 22 just shot up. All right, that's what we need to do. They had loan officers that they had to feed the machine, and there wasn't the agility of a small bank, and there wasn't the discipline and operational leverage of larger institutions.
Yeah.
No, you look at the combination that resulted in Truist. And at first, it really bothered me because they renamed the ballpark in Atlanta Truist Park. It took me a while to get used to that name, but the combination itself really makes a lot of sense. And the stated purpose was we need to have better technology. I mean, that was a large stated purpose, and I think that makes a lot of sense. Now you have you have kind of a regulatory environment right now that's almost hostile to the kind of combinations that need to occur. But I think to Umre's point, they need to occur. Now, you're going to need to start putting some of these banks together.
We have a poll question regarding, as you're at your institution, how has your relationship with your regulators changed? Significantly more oversight, moderately more oversight, no change, less oversight. By now, almost every bank should have had an exam post-crisis, or most of them. Umar, is this what you're seeing?
That feels, well, I know the part that I would have guessed, and many would have guessed, is 0% in less oversight. So that makes a lot of sense to me. No, it feels right. And you talk to management teams, and I think it's very much size related. If they're under $1 billion, they're not on the radar, unless their model, even if their model, I should say, sticks out a little bit for someone that would be larger. Yeah. But it's not on the radar. Above $1 billion, under 10 billion, definitely 61% feels like what's happening. And then significantly more oversight. That percentage, 1 in 6, feels like the number of banks that are really under stress, liquidity, interest rates, et cetera.
Or banks that are in more scrutinized areas like banking as a service or things like that, where the regulators have just come in with SWAT teams.
Yeah.
Even if nothing's going wrong.
It does seem like, never bet against the banking lobby. I mean, the capital rules came out, and now Powell's backing off from that. Jim, you know more about this than I do. I know there was some new CRA rules that were supposed to come in April 1st, and my understanding is they got an injunction to delay the implementation of those rules.
Massive change, John, massive change. I'm sure CRA is not something that most people on this call want to pore over, but it's significant, and it's going to have a huge regulatory impact. Essentially, the primary federal regulators rewrote the CRA rules. It's what is it? I think 60,000 words, just the regulation itself. Wow. It's thousands of pages in the Federal Register. But a coalition of both business and banking organizations came together and filed suit out in Federal District Court in Texas. And it's included the American Bankers Association and the U.S. Chamber of Commerce. And there was an injunction put in place on April 1st, essentially delaying implementation of what they call the final rule, the new CRA rule. And it'll be interesting to see how that plays out. I mean, the primary focus seems to be that it's focusing on of the lawsuit is the challenge to, hey, you're focusing on deposits more than just loans. And basically the test is going to be well beyond where we have physical locations. But there'll be new tests, there'll be new points of measurement, and it's going to be just nirvana for CRA consultants. This is like 10 years of work. and for the compliance groups within large banks. But, again, just in my view, it was there needed to be some changes, and they went well beyond just the necessary changes.
I mean, is it safe to say that the assessment areas are just simply getting larger, Jim?
Yes, very much so. And tracking and starting to track deposits, which, in my mind, that's not the original intent. I mean, when CRA was put into place under the Carter administration, it was basically, hey, we want to increase the amount of lending in low and moderate income areas. I think everybody can say that's a good idea. We all should get behind that. I think, frankly, the industry has gotten behind that. But, it's an interesting regulatory regime in Washington right now. And I think a good idea to modify the CRA rules, bring them more current, got overblown. And there's been a significant pushback and litigation. It's going to be interesting to see how this litigation plays out.
Jim, it sounds weird to think about sourcing deposits where you're supposed to, where there's an unmet need in terms of capital.
Yes. It's the testing. And again, I am not a CRA expert by any means, nor do I ever want to be. But to me, it's the change in the way things are going to be tested and measured. That's the biggest challenge. And it's going to hit the biggest banks. For banks under 600 million in assets, there's really going to be no change. But for banks over 2 billion in assets, and that's not that high a threshold, there's going to be significant change, significantly more cost, significantly more oversight, if and when this ever actually becomes, implemented. So stay tuned. It's in litigation.
I generally, as a rule, I worry less about regulations going so far off the rails. You always hear the cliche, oh, regulations are going to drive me out of business. I've never actually met a bank that failed because of regulations. Yep. The unique thing about banking, right, true banking in anywhere in the world, it's the lifeblood of commerce, right? If banks vanish, like that's it. You're back to bartering and clubs. It is a fundamental utility. Banks don't really want to hear that, but there was a day, right, when they were just regulated like utilities. And so if the whims of folks in DC, depending on what party controls the seats at any moment in time, if they go too far out the norms, you are going to face off to the largest oligopoly on the planet, right? And it is an industry that has to generate a certain amount of NIM to survive, right? And if you make things just too painful, it's truly not feasible, then they are going to push back. And ultimately, the regulators have to bend within reason to what the mass wants, because they have to provide that liquidity of commerce to the citizens of the country. So I never worry too much about it going too far off the rails, because if it does, the banks ultimately own the card, because if they have to just say, well, then I'm just not doing that anymore, what happens? We're going to throw the economy into chaos? No, Washington has to be realistic.
Yeah. You guys are all involved in the banking industry. We're looking at about 4,500 chartered banks in the U.S. right now, about an equal number of credit unions. So it's interesting. But, how many banks do you think we have in 10 years?
Oh, that's a good poll question. I would think 2,500.
Ray?
If you put a gun to my head publicly, I would say somewhere in the 3,000 area.
Yeah. John?
Yeah, I would tend to agree. I think there's certainly a cohort of banks that would like to sell, and there isn't really a buyer for them. So I think as you get into the 3,000s, there's fewer and fewer banks that have both the desire and a good partner for them.
Yeah, and I fully agree with that. I know a lot of banks where there's no intention to sell. They the shareholders are making money. Particularly the privately held banks, family-owned banks. And they see that they're providing a service to the community, as you said, Josh. And that's one of the things I love about our system. What'll be interesting is if we ever start adding more banks in significant numbers over time. That I don't think it's going to happen anytime soon, but I'd like that to occur again in my lifetime at some point.
Yeah. Well, overall, one thing I've noticed in the bank earnings so far is an awful lot of differentiation. You had the very largest banks, credit was the same. You had certain banks like US Bank, PNC, and others that saw big increases in non-accruals and so on. It was definitely a quarter where, while there were some common themes, there seemed to be more differentiation on performance.
And and like Josh knows it, I mean, particularly for being an investor, in any moment of time like this, there's great opportunity for some people right now that are fully taking advantage of it, right? I mean, Fulton Bank had a great day when I mean that there are opportunities in chaos and in turbulent times, and those are the interesting banks to watch, I think.
Yeah. Well, I mean, it sounds like now that rates are going to be higher for longer, we can all debate how much longer. I am noticing some banks are taking the hits on their securities portfolios. But what do you think is a typical payback period that banks are modeling, or when does it make sense to do it? 2 years, 3 years? Can you give us some color on the decisions that CFOs are making at banks?
Sure. It's probably beyond the interest of everybody on this call for us to get too detailed on paybacks, but let's just say there's more than meets the eye. So when you see a public announcement with a payback period, it says very, very little about what cash flows the management team got rid of and what cash flows the management team reinvested in. So we at PT are very careful with these single statistics, and I guess the best way to answer your question is there were instances that we saw that were really accounting gimmicks. Yeah. Basically, I'll take some capital hit to clean up my income statement going forward. Doesn't change much about the bank because either you take the loss through income today or you take it over time through lower earnings. If a bank actually repositioned to modify its sensitivities to shift around its asset liability position, those are good rational losses to take. So the short answer is stuff that didn't make a lot of sense, but plenty of stuff that did make sense.
Josh, what have you seen your banks do?
And it's all over the map. It really just depends on, it runs the gambit. You have banks leaning in, banks on hold. Some banks are taking deposits, at the marginal cost because they have opportunities. Others are saying, I don't need funding right now, which just telegraphs that they're not making much in the way of loans. So I don't know if I have a single answer. It really is very case specific.
Yeah. And we got a question. If feel free to send any additional poll questions. But one person asked, how long should a lender double down on an office building and advance funds for leasing TIs before cutting bait?
Need more info.
Yeah. I mean, I think the problem with this premise is, I mean, you gotta, when you're at the moment of time in which you're deciding what the future is for this asset, be it a workout plan with a borrower or taking an REO, you need to have a realistic sense of, okay, what am I signing up for? And certainly if you budget for X and it's dramatically different, just like with a construction project, you need to have some sort of contingency there. And I think that management teams, need to have a good realistic sense of what they can expect. One thing I am noticing is, advice we're giving to some lenders is if you're not going to sell the office loan and you're having issues with the borrower and the public thinks that the borrower is a good sponsor, there's a lot of value into making the market think that the distressed office borrower is not distressed. Leasing brokers want leasing commissions, and they want to lease properties in healthy buildings. So there is some rationale to work with the borrower quietly and not let the market think that you've got a troubled borrower to troubled building. Because once the word gets out that this is a receiver's involved and a B-piece owner is calling the shots here, you're not going to sign a whole lot of new leases.
Yeah, if you want recovery value in a building, fill it up.
Yeah.
I
The
mean,
only thing
even
I'd add to that-
even if the rent's lower, if you have the rent roll at least, then there's a market value for it. An empty building, good luck.
Yeah.
The only thing I'd add to that, not an expert at all in that asset category, but any asset's value is its cash flows it's going to produce from now until judgment day, present valued. So reminder that it's really about what it's going to produce in the future and not where you own it.
Yeah. Well, wrapping up. So I know we all hate predictions, and this is recorded. But as of right now, the 10-year is 4.66%. Where do we see the 10-year at 12/31? And want to take a guess?
You should never ask a lawyer for a financial prediction, so I'll defer to these other two.
I'd say 4.5.
Yeah.
You're not going to like this answer. It sounds like a business school answer, University of Chicago type answer, but who the heck knows? Be prepared for up 100 unchanged or down. So it's my way of moonwalking out of that one.
Good answer. Well, that about wraps it up. Bob, you want to come on and sign us off?
Excellent presentation, gentlemen. I enjoyed the conversation. I am disappointed, John, you were not able to get the panelists to commit to your question, but
Oh, you'll check on me
Bob.
in
next
8
time
months.
you ask that, do not lead with "we're recording this." Just some
my
information.
bad.
John, what do you have? What are you thinking about in your next webinar? What are you thinking about doing?
I think we're going to do a commercial real estate lending webinar probably in about 5 or 6 weeks. And then I think we'll do another workout one in about 3 months from now. And I'd also like to do a C&I one at one point. So hopefully you'll continue to enjoy these and obviously love working with you and your team and these fine panelists.
Panelists were awesome. Very good. And this concludes today's webinar. Thank you all very much.
Thank you.
Thank you.
Take care.